Welcome back to my live stream. We're going to talk about stocks, and we've had a rough week. We've had some stocks that have gone down, and hopefully, we get a nice pullback, maybe correction out of the way, and then we have a very good 2025. It's been a really good 2024, so I'm not going to complain too loud about a little bit of a pullback here at the end of 2024. But it has been a little bit of a giving up some gains process. Today isn't so bad. We've got the S&P down just a little bit, 0.25%. The Nasdaq's down 0.6%. The Dow has probably been the worst performing index in the last 30 days. It's down 2.42%. And if you really look at the month, it's down 5.7%. So it's not the month of December, the index is down quite a bit. So that's what's going on. Looks like Android PC is on. How you doing, man? Good to see you. Thanks for joining. If you guys want to talk about particular stocks, please put them in the chat. We'll take a look at them. And if there's a topic you want to go over, please put it in the chat. I've got a few topics I wanted to open up with, as well as I've got a few ideas on stocks that I wanted to go through. Nike reported their earnings yesterday. Accenture, FedEx, I thought those were pretty neat. Hey, Mike, good to see you. Thanks for joining. All right, so let me get into just a little more information, just high level. I thought it'd be interesting to take a look at the NASDAQ as well. How has it been doing over the last month? And specifically in the month of December, the NASDAQ is still in the green, 0.21%. And the S&P, we are in the red for the S&P, down almost 3%. So it's been a month where we're giving up some of our gains of 2024, and naturally the stock market does not go up perfectly, just up and to the right. It's going to have some bumps along the road, and we are experiencing a bump. How far further is this going to go down? Let's take a look at a couple pieces of information that could continue this sell-off. Good to see you, Rotel and Cheese. Good to see you. And I guess it's Ro. Good to join. Good that you joined. All right. So one big report that came out was the Personal Consumption Expenditures Price Index, PCE. And this report does have an impact on inflation. And it is a measure that the Federal Reserve looks at as they set policy. And you can see that for the past year, this measure had really gotten down, and now it's come up a little bit, not too bad, 2.8%. But over the last 5 years, you can see it was really high. In 2022, it was way up there. If you recall, we had crazy inflation a couple years ago with car prices, and eggs were like $8 a dozen. I mean, it was nuts. And now we've kind of gotten it back down. If we look at the 10-year, we're still above what we were experiencing back in these years that I'm going to label as normal years, because this was pre-COVID. It was just, we were in a decent economy, and we had the PCE floating between 1.4 and looks like, call it 2. And we're not near that number. It'd be nice to see that come down, maybe down to 2, down here in this range. So the Fed, I think, they've made comments that, hey, we're not going to be easing on interest rates all that fast. Maybe they're looking at this data and they're looking to get this measure as well as other inflation measures down so that they could see inflation begin to subside completely. We'll see. That's my observation of it. So with that PCE report, the market is kind of flat. I'm not going to call this a super down day. It's a little flat. There's one thing that's out there that could kind of make a situation a little worse for stocks, and that is this government shutdown that could happen. The House of Representatives is looking at how they can get a bill across that would fund the government. And if they don't accomplish that, there may be a government shutdown. And what does that mean? It means that federal employees wouldn't be receiving a paycheck. I'm not sure if they'd be sent home. Maybe they would. It just would affect the economy a little bit to the negative side. You're not having, that part of the population spending money. And it's right before the holiday. So maybe they cancel a few trips that they had expected to make. They hold back on going out to restaurants and so forth. So if it's a long shutdown, I think it could have an impact in two ways. One is psychological, like what the heck, the government's not open for business. That would be a negative. And then second, the spend from that area of the economy would not be there. Also, suppliers may see a delay in getting paid. So that whole ecosystem would be impacted. That depends on the federal government. So we'll see how that works its way through. It's government. So it's somewhat predictable, but if it takes a while, that wouldn't be a giant surprise for me. So that could affect stock prices. And this information, I kind of look at interest rates. I'm not like an investor that just looks at interest rates and that's what forms my strategy. But I'd look at them because I want to see, where are they at? And rates have fallen today, which is good. I think that PCE report helped in bringing down these inflations, bringing down interest rates. Interest rates are set by the market. They're not set by the Federal Reserve. They're set by a market. Investors coming in and saying, I want to buy 10-year bonds. And if a lot of them come in, it lowers rates because the price of bonds goes up. If there's few buyers of bonds, rates go up because there's fewer buyers, so it's less demand. So the bonds have to attract investors by raising interest rates. So it looks like, there is demand on bonds today, which is looking good. I am on days when you see rates go up, this showing green, I buy into bonds. On days when we're seeing red, I sit back and let's see my bond values go up. And that's how I've been able to, I just manage my low risk part of my portfolio. Part of it is in cash, which isn't bad. It's doing over 4% yield. But that's not going to last forever. So it'd be nice to have some dollars in intermediate bonds as well as some longer term bonds. And that's what I've been buying into when these rates go up, and it gives me a better rate of return. When it goes down like this, it raises the value of those. All right. So those were a few opening comments I wanted to talk about. And let me go through a few comments here. Magical Self. How are you? Cool handle. So you want to look at MKSI. Yeah, we can look at that. And Row, Bitcoin seemed to be a leading indicator of the market nowadays. Yeah, I think I couldn't argue with that. Yeah, if you look at Bitcoin investing, it is a riskier investment. And if you see a lot of investment in Bitcoin, I think it would probably correlate with the NASDAQ as well as, the higher growth stocks, higher growth tech, and so forth. So I would agree with that. What are my thoughts on DocuSign? Ooh, I got lots of thoughts on DocuSign. I'm a stockholder. And Hyper Wizard. Thanks for joining. I'll go over that. I'll put that on the list. All right. Thanks for the questions, guys. Thanks for joining. If you just joined, if you have a stock you want to look at, please put it in the chat. If there's a topic, put it in the chat. We'll go through it. This is Friday. This is the end of the week for trading. Next week's going to be a slightly shortened week, right? We have Tuesday is going to be a half a day of trading, and then Wednesday, Christmas. So we will take Christmas off, and then we'll come back. Volumes, I'm not expecting very high trading volumes, but the market's going down. I think we could kind of begin to go down, and it'll let some of the air out of the bubble, so to speak, because I am expecting January could have a pretty good pullback. I'm looking to sell some stocks in January. I don't want to sell them in December because I already have a fair amount of taxes to pay. And if I sell some of those stocks now, I'm going to pay more taxes. So I'd like to avoid that. So I'm looking to sell in early January. Looks like, Mike, you want to look at TRIN. Glad to. So let's keep rolling. Thanks for the comments, guys. Thanks for tuning in. Let's take a look at one more general measure, and then we're going to get into these stocks. So I like looking at which sectors have been performing really well over the last month to kind of show momentum, and then, as well as these factors here. Consumer discretionary up 6.45. Tesla's in consumer discretionary. A couple of others, including Nike, which is not doing well today. But consumer discretionary is getting it done. 1 year, 34. And it's really been doing well over the 5 year. Go to consumer discretionary. Number 2, communication services. That's where Google, Meta, Netflix, as well as Disney and others, AT&T, Verizon, that's been doing well. The 5 year, not as impressive, but one reporting detail is Google and I think Meta were added a year or two ago. They used to be in technology, but then they were added. So this measure is somewhat not representative of what really happened. Then technology is up nicely, up 3.77 over the last month, and it's rocking the world. 499% return. Awesome. So you see where it's, no big surprise. These sectors are making it happen. The sector that is super interesting, energy. Geez, what the heck's going on with energy? And I'm going to look at Chevron. And Kiter wanted to look at Chevron, so I noted it. And I'm a Chevron stockholder, so might as well look at it. And it's, this sector is down 10% in the last month. And with the Trump administration, right, you'd think energy is going to do well. He's going to open up more areas for exploration, and but it's down. I'm looking to lighten my investment in Chevron. I still can't sell any of my shares because they're at a gain, and I just don't want to pay any more tax. But I own probably about 100,000 of Chevron. I like to bring it down to about 80, and then invest potentially in other energy companies. So we'll see how I feel in a month or two. Material stocks, as mentioned, I'm getting out of TX and just don't want to be in materials. Part of it is that, I want a high rate of return. So I'm looking, for more biotech, technology, and communication services to some extent. I already own Google and Meta. Those are my 2 biggest positions. So I think I'm good there. And then some consumer discretionary, like Amazon is in consumer discretionary, by the way. That's another company that's making this yield look really good. So the sectors that have been working, there they are. The sectors that have not been working, here they are. Real estate's not been working. I think the expectations, interest rates are going to stay up higher for longer. So that's going to put a little more downward pressure on real estate assets, as well as the companies that are building new real estate, holding real estate, and so forth. All right. So Mike, you want to look at Novo? Yeah. Novo is not having a good day. Not at all. Okay. So I'm going to I'm just going to start with the list that you guys are suggesting. And then if we have time at the end, I'll come back to some stocks that I thought would be interesting to cover. But let's go over TRIN. So Trinity Capital. So Trinity Capital is a business development company, venture capital firm specializing in growth capital, innovative medical devices, venture debt to growth stage companies looking for loans and equipment financing. Okay. So they're headquartered in Phoenix, Arizona. So this stock over the 5-year hasn't been a super winner. Over the 1 year, it's been a small loser. Big dividend payer. Very small cap, under $1 billion in market cap. Very low PE. Okay, so this looks like a income play. I mean, this is a phenomenal dividend. So I'm going to look at a couple of things, the health of the company, and I'm going to look at the ability to pay that dividend, because I imagine an investor would want to get into this stock to get that yield or that dividend. So the company is small. They have been growing really, really well. This is excellent growth. They are profitable. Looks good. Negative free cash, maybe because they bought a lot of equipment. That's the business they're in. I'll look at that statement in a bit. They're not really a producer of anything, so gross margins are 100%. So I like the growth of the revenue. That looks good. From a cash flow perspective, so operating activities, not sure what that is. Yeah, I'd have to look at their actual financial statements and see what's going on there and understand their business a little better. Now, what's key is right now they're paying out 118% of that dividend. So will they have to scale back the dividend? That's the question. It seems like they may have to some extent. Let me look at their free cash flow. See, they're not free. They don't have free cash flow. So, So net income. So 87 million of net income. Yeah, this one here, I think the what I don't like is the dividend payout is just way too high. It's just not healthy for a business to have 100% of profits be, provided as dividends, because they should be reinvesting in the business to try to get bigger, try to get stronger. So I don't like that. The other reality is this stock hasn't really attracted long-term investors that believe this company in itself is just going to be worth more. It's like, hey, investors are going to like a Palantir, probably thinking, hey, that stock's going to be worth a lot more in the future. There's that type of mindset. And I don't think that mindset exists for Trinity. It's a income play. There's just a couple of red flags. The payout ratio is a red flag. I would encourage anybody looking at this stock to really understand that statement of cash flows and form an opinion on, do you think they're going to do well going forward? Do you think these guys are going to be a really good company to own? That's really an important chasm or threshold that I have to cross. If I don't believe in the company, I shouldn't invest in it. I just have worked too hard for my money. If I don't believe in it, I'd rather be in lower risk, bonds, because I'm only going to make 4 or 5%, but I'm not going to be, surprise and lose half my investment in a company I didn't believe in. That wouldn't be a good idea for me. So it looks like, Mike, you're maybe agreeing with that. Yep. Well, income is good for some investors, and good luck with the rest of your investments in that area. So, Tomas, good to see you. Buenos dias. All right, so it looks like Novo's getting a lot of comments, so we can go to that. Let me catch up on the comments. Overreaction. I think their drug failed. Their weight loss drugs failed. And do you guys know, are they going to try again to kind of get that to work, to get that drug to work, or what's the story there? All right, so I'll take a look at it and see what I think's going on. So Novo was doing quite well. I think, yeah, it was doing great, up 189% over the 5-year. And that's with this pullback that we're seeing, 19%. Oh my God. And this chart is not showing that big drop. So let me go to Google. So 188, it's dropped a lot today. Wow. So today's drop is really taking the stock down. It's down 19.24%. So let me take a look at their financials and see what I think is going on here. So this is a big cap, right? 457 billion. The PE was a little bit high at 32, forward P of 28. Okay. And let me see some of these storylines. I haven't gotten deep into what's going on at Novo Nordisk. I'm not an investor. And so the Calgary SEMA delivered disappointing trial results for their next gen weight loss drug. I believe they have a weight loss drug that's commercially available. It competes with Eli Lilly. Eli Lilly is the leader in the space. Okay. All right, so some disappointing news. Let's take a look at the financials and see what's going on. So that disappointment in trials, right? When you have a drug going through trials, it's not commercially available, meaning you're not selling it. People are not using it. So these numbers are not affected by that story. This is for all existing products that they're able to sell in the marketplace. And I'm seeing really a real prosperous business, up 26%, quarterly, up 21%. And part of this, gradual lower percentage growth rate is that the number that you're comparing to keeps getting bigger. So that's understandable. It's not like a big giant concern to me. It's actually understandable. So they're growing real nice. Now, the thing I like about pharmaceutical companies is usually they have superb gross margins, 84%. I will toast my coffee to Novo Nordisk for those margins. And that's why they're worth $450 billion is gross margins, and free cash flow, 77. Now, let me take a peek and make sure I'm looking at the right currency. See, I caught myself. It's a DKK currency. No problem. What? I've got this smart AI engine behind me. See how fast Meta AI is going to answer that question. Took a little while. I think Google would be a little quicker. So it's about 0.14. All right. So 0.14. And looking at their free cash flow, it's going to be about 10 billion. And I could do a full valuation. It might be worth it because close to 20% drop in a stock, I think, is a little overplayed. We are in a declining market. What's interesting when you're having sell-offs, right? And it'll be cool to, it's great to experience markets that are appreciating with you guys, because then we're like, all right, cool, man, stocks are going up, it's great, making lots of money. But when we have these sell-offs, it's also an opportunity, because sometimes, like Novo Nordisk may be like, hey, the market's overselling it. So we can then kind of say, hey, this is a pretty good time to buy. When everybody's afraid, when everybody's scared, be greedy. That's when you get a really nice discount on a stock potentially. So why don't we dive into Novo Nordisk and do a valuation on it and see what I think is the value behind this company. Now, I am an investor in Pfizer, and I consider Pfizer, Novo Nordisk not doing the same thing, but they're both pharmaceutical companies. They're not selling the same type of drugs, but they are the same type of company. And I will use that as a starting point, and then we can do a valuation on Novo Nordisk, see if it's a good buy. All right, so hopefully I spelled that right, correct. Discount rate 8%. I'm good with that. So free cash flow. So I'm going to move this guy to my other screen so I can use my two screens in my favor, and then update my spread, or my sheet, my Google sheet. So this is going to be trailing 12 months for now, and then I might grow it a little bit. So this is going to be 77,748 Danish krone, I believe, times 0.14. So that's 10 billion. Now, do I expect that this is going to grow? It looks like they've been growing their free cash flow, but they have had kind of a little bit of a dip if you look at the quarterly. So I'm just going to leave that alone and grow it by 10%. Not quite. I'm going to go to 7. And long-term growth, 4%. So that'll set the forecast that I think is a pretty good forecast for Novo Nordisk for the future. We're coming in at an intrinsic value of $275.7 billion. So cash on the balance sheet, let's take a look at that. Wow, nice. They have $11 billion. Wow, nice. They have less debt, so strong balance sheet. And then debt is $8.520 billion. The market cap for Novo Nordisk is $457.620 billion. So it's overpriced by 41%, even at this reduced price. And, the weight loss drugs are a little bit like, not as crazy as the AI hype, but, it causes investors to really put a high expectation on these stocks. And if we look at the 5-year, right, we've got a stock that's pretty much tripled in value. It was trading, call it at $40 a share, and now it's up to $83, which is doubling. But not too long ago, is had tripled, more than tripled. So you could see that there was a lot of price action on the stock that really fueled it up. And now investors might be thinking, well, all that really optimistic growth may not be in the picture. And based on what I'm thinking, if they're just going to be a growth company, even if I said, hey, they're going to grow their free cash flows by 15% over the next 4 years. And the reason I go only 4 years with that cash flow is competition is going to come into the market for weight loss. And who knows, you may have an administration that says, hey, we're not going to cover weight loss. If people want to lose weight, or the guy that's supposed to be in charge of the healthcare or health department with the feds, he's come out and said, hey, people should just eat the right foods and exercise. So even if I went really optimistic, it's still really hard to get there from a free cash flow perspective. So I would not be touching Novo Nordisk, and we'll see how that plays out. But thanks for asking about Novo Nordisk. It's interesting to see that it's selling off, and I would not be buying it. Selling off 20%. Wow. If you look at the 1 year, this was a big winner, but this year it'd be officially a loser for an investor. A pretty good one. The dividend's still somewhat low too. All right. So Novo Nordisk taking a big hit. All right. So got through that one. All right. Let me catch up on comments and then we'll get back on the list. So Tomas, you want to look at Dropbox? Let's look at Dropbox. And hey, thanks, Ro. I appreciate the comment. Okay, so we're going to look at DocuSign and Dropbox. They're kind of similar. I'm going to look at DocuSign first and then Dropbox because it'll kind of serve as a decent example. They're both, in my mind, software companies. They do different things, but they provide software and they provide it on the cloud. DocuSign is the #1 digital capture company, and it's been getting it done. In the 1 year, it's up 50%. This is a smaller cap company, up 19%. Over the 5 year, back in COVID, everybody thought, man, DocuSign is going to do everything. They're so great. And the stock was really pumped up and then it dropped. I started buying probably a year and a half ago, and I'm glad I bought the stock. It just seemed like a lot of value behind the stock. PE ratio is reasonable at 19.48 and then forward P at 25. The reason I say that is this is a growing company. Even though they grew very fast during COVID, right? You saw their growth rate because we went from people meeting and signing documents in person to, hey, I got to do everything online. And DocuSign became just a greater necessity. Speaking of necessities, I got to have my morning coffee. So DocuSign is seeing competition from Adobe, but I happen to believe that in software, and we've seen this play out, is the best user experience usually wins. Google search. Google was not the first one to get into search. They were like the 50th company that came into search, but they did it better. They had a better result, better outcome, and they won based on user experience. And I can go on and provide examples. So I still believe DocuSign has the user experience advantage, and Adobe would love to come in and say, oh, but we can do it just as well. And maybe if you went head to head, maybe, but the adoption of DocuSign is just so pervasive. There's so many industries that are just dependent on DocuSign that I think they've got a very strong moat based on the network of people using DocuSign. And a lot of software companies have integrated DocuSign into their software, like Salesforce.com. So I'm a believer in DocuSign. I really like the company. I have a valuation on DocuSign since I am an investor in the company. I can show that to you. It has been a stock that has come up as a potential acquisition. I think some a private equity group was looking to buy them, and it really had a nice run up. Right now, I think the stock's actually priced at about a 3% premium. It's fairly priced. 3% is nothing. And I think their cash forecast is really good. It really supports the stock. It's a solid company. When you look at um, their profitability, let's look at that gross margin. Gross margin 80%. Beautiful. Free cash flow has been growing nicely. So this is an acquisition target for a bigger software company. Now, one shouldn't invest just expecting, oh, they're going to be acquired. But I would not be surprised if DocuSign gets acquired, because a bigger software company can add $2.9 billion of revenue. It's profitable revenue, good free cash flow, and maybe make themselves stronger and better. Think of a Google Alphabet. Think of a Microsoft. Think of companies like that that can integrate this product into their software platforms. Even a Salesforce, if they start acquiring businesses again, might be a good buyer of DocuSign. So we'll see how that plays out. For now, I'm holding on the stock because, as I showed, it's a fairly priced stock. So the buying was good a year and a half ago. And we can't trade by looking at the rear view mirror, right? We can only look at the rear view mirror and say, wow, it was a great buy in August. Pick up shares at $50 a share, and your share value would have gone up really nicely. So that's DocuSign. It was a winner. So let's go find the next DocuSign and buy it around this era. And let's see if maybe Dropbox is that next company. Now, Dropbox is a company that is in storage, and they do content collaboration, which is a different way of saying storage, meaning you store files on the cloud, you store them on the Dropbox cloud, and then you can share them with your family, you can share them with your coworkers, students can share files and so forth. It is a really nice service, but they just have intense competition from Microsoft, Google, because Google has Drive, Microsoft has their OneDrive. I mean, the competition's intense, and it is somewhat of a commodity to be in storage. So I'm not a big believer in this space. I'm not, see how the stocks perform. See how the stock's really not done much, even though they're a software company. We'll look at their growth in a bit. It's a $9.36 billion market cap company, and our friends at DocuSign have doubled, so they were at 10 billion. 17 PE ratio for the current year. Next year, it's going to be nice and low. They have been growing nicely. This is probably just growing like as people add more to their storage, their files that they're storing, and they just have to pay more, which is understandable. So this is a little bit of a slower growth. Let's take a look at their margins. Gross margins are really good, 82%. And free cash flow is very good. Just I think what's holding back this stock is that, so I work in the software space. This is what I do for a living. And I'm not optimistic about Dropbox's future, because it's just going to get harder and harder for them. Google is pretty darn good. And you think about how many people have Google Gmail. Well, very easily you can go become a Drive. Actually, you have to become a Drive customer if you have a lot of emails and a lot of attachments. And you just keep going on and on, right? And if you look at Microsoft, another competitor, well, if you're a big Microsoft customer, everybody's moving their files to the cloud, you would very quickly become a OneDrive customer. That's direct competition with Dropbox. It's not like DocuSign, where, Google and Microsoft don't have digital signature capture solutions. So this one here, I'm like pessimistic about the industry or the company, I should say. So I would stay away from it for that reason. I think the value is there in the company. You never know. Maybe another company acquires them, but That's not the basis for my investing. The basis for my investing is trying to find companies like DocuSign that, hey, I think it's unappreciated, man. This is a good company. They have good competitive advantage. They have good momentum, good growth. And I bought around here and have made good money on it. This is what I'm looking for. And I don't think Dropbox is going to achieve that. You see that they're flat for 1 year, while technology's been doing great. So Dropbox just not a desirable company to me, and I would stay away from it. Fundamentals look good, but I think this is what you could say is a value trap. You get trapped by the fundamentals. Like, oh my God, the fundamentals are really good. But qualitatively, I just don't think they're going to go places. So thanks for asking, Tomas. Hopefully that is helpful. I'm glad you're looking into technology. The one company that I'll kind of add on my own, I've been, waiting. I've been telling myself I got to analyze OpenText. This one here came up when we were doing the screens, the stock screens on the investor workshop. This stock looks interesting. It hasn't been exploding. It's been imploding. But when I look at the growth, it's there. Gross margins are there. It's like, what the heck? I know the operating margins are the operating expenses, like the back office expenses, are a little high. So they got to control those. But 76% margins, free cash flows there. Yet the stock has been going down. What does OpenText do? It really helps in enabling companies to operate online. So they provide technologies, services, softwares for companies to operate online. Well, that's just going to keep growing. So this is one company that I'm going to do this weekend. Is I'm going to analyze this. I'll create a video. But, this is for you, Tomas. I'm glad you're looking at technology. You're a younger investor. I would wish for you to buy stocks that you put 10 grand in a particular company. You wake up 10 years from now and it's worth 200 grand. That's what I'm hoping you achieve. And you can achieve it if you buy these companies that are just growing in the right spaces, that are really profitable, that generate a lot of free cash. So I'm glad you're looking in technology. All right, so let's keep rolling. Looks like Shadow Guy is making an appearance. And Shadow Guy, good to see ya. Thanks for coming in. Mike. So that's a very good question. Let's talk about Nike. Oh, man, it's only down 1.43%. So they announced yesterday, and if you saw my video, I looked at the financials and I didn't like the financials. And I kind of felt kind of weird that I'm like looking at the financials going, wait, they dropped revenue by like 9% if you look at constant currency perspective. And the market had them up like 6% in after hours trading. And I was listening to the earning call, and the CEO, like the stock is up 6% in after hours. And as soon as he started saying, and FYI, we are going to sacrifice short-term performance to get our strategy right. And then the CFO reiterated that. As soon as the CEO said those words, it went from up 6% down to the negative. It's like, yeah, investors are like, hey, well, what does that mean? You're going to like crash and burn for a while? And it might be the case. 37% down in a year. I started buying because I saw that, hey, these guys, Nikes, there's only one Nike. They have dominant market share in the athletic shoe market, athletic shoes, footwear. I'm wearing a pair now. 90% of the time I'm wearing a pair of sneakers. It's just more comfortable. And heck, my mom's 89. She turned 89 on Wednesday. She goes around with a pair of sneakers. She knows where it's at. It's comfortable. Even, formal environments to see people with shoes wearing sneakers. So the sneaker market is very, very lucrative. And Nike has very good margins. Their margins were at 43%. Cash flow is good. And I think they're in a troubled time. I'm going to hold my shares. I don't see a big problem. I want to see another quarter. I think the loss of revenue is not as bad as the previous quarter. And I do agree, like Nike made a decision with the previous CEO where they started to alienate some of the smaller retailers like Foot Locker and other retailers. And they did that because they thought, hey, it's going to be more valuable to Nike to put those smaller retailers in a distribution channel. They have to go to a wholesaler to buy their shoes. And they were going to somewhat limit like the coolest, nicest shoes and keep them as a direct sale to the customer and try to establish more of a direct model. And I could see how the previous CEO was like, yeah, everybody has a direct model. You look at Google, Meta, look at all these awesome companies that obviously have a direct model, but they didn't pull it off, and they actually hurt themselves because the small retailers ended up saying, okay, well, I guess I'll switch over to Adidas. I'll switch over to these other brands. And Nike forgot what built their success, which was just a real passion behind their shoes. Passion being, kids saying, hey, I want a pair of Nikes. Adults saying, hey, I'm very comfortable with Nikes. They're a good quality shoe. They're designed cool and, they're good in the gym and so forth. And when you started to have more choices, like I shop locally and I don't buy everything online, and shoes are one of the things that I have to try on. Like I know my size in Nike, I know my size in Adidas, and they do vary, and I still have to try them on. I bought a pair of sneakers. I bought some Nikes the night before the earnings call. I guess that was Wednesday night. Yeah, I went to go see my mom, and then on the way back, I stopped by a big Nike store in LA, and place was packed, and bought a nice pair of Nikes. And wore them all day yesterday, hoping that Nike would do better than they did. But it didn't work. I'm glad I kept my receipt. So all kidding aside, I think the premium athletic footwear market, I'm glad to be an investor. I'm okay with where the company is at. I like that they brought back the previous the CEO that has history with the company. The Nike story is not like the things that I like about the Nike story. When they were little, when they were a small company, they got there because they just tried harder and they kind of broke some molds. They signed the right athletes. They went all in on the right ideas. They have to get back to that. They shouldn't try to be Facebook. That's not who you are. Who you are is a company that, for example, the line of Kobe's that was a line after Kobe Bryant, who's now deceased. It's doing really well. Serena Williams, I think so highly of Serena Williams. She is phenomenal. What an athlete. She's been so successful in tennis, and her line is doing great. That's where you got to go, Nike. Spend your time getting more stories and more passion behind your shoes instead of trying to be Facebook. So I'm glad they're back on the right strategy. What would cause me to sell is if all of a sudden Adidas just started doing great and Adidas came out with something that's like just a game changer in the space, I'd have to recognize, whoa, Adidas is bringing it. They're going to be a big competitor to Nike. But right now, Adidas is not. Adidas is nowhere near where Nike's at. If Nike can just maintain their leadership and get their strategy to work, I'm glad I'm a Nike stockholder. If they can't get their strategy to work, and Adidas is really the only company I see as a competitor. I know there's some new brands like Deckers Outdoors has the real comfortable shoes. I forgot the brand. And some other brands are out there, but if you look at their volumes, they're tiny. It's like, yeah, you're like a 20th the size of Nike. You're nowhere near the volume that they do. So Adidas is the only one that's like, okay, that's the real competitor. It's kind of like Microsoft, their true competitor is Google Alphabet, and Google Alphabet, vice versa. Those guys are massive within technology. And you can compare, big giant companies that are really successful against one another. All right. So that's Nike. I'm taking a little haircut. Not too bad. Not too bad. Dividend keeps getting better, and but I don't invest for dividend. I think the analysts still think it's discounted. What do I think of Nike? Let's take a look at Nike. Yeah, I kind of agree with the analyst. It's got a modest discount, 18%. It's a solid company. I updated all this information yesterday, so after the earnings. It's a good investment for me. I have a fair amount of shares, consumer discretionary apparel. I invested 30,000, kind of held there. I'm glad that I didn't like go all in 100 grand or something. 30 grand. Okay. I'm down 7%, waiting for things to look right. And then maybe I'll move up my investment to 50,000. All right. So that is Nike. We'll see where that stock goes today. It should be getting a lot of attention. All right. So we went over Nike, and the market's coming back. Breaking news. The market has come back. Looks like Android PC flipped the switch, and now the lights are on for green on the screen. Very nice. All right. Enough of that pullback. That got old fast. Genetic smite. Oh, brutal. I've been there. I feel your pain. Yeah, I hear that. My wife is, I'm not familiar with Ultra. She started, man, what is that stupid brand? They're like kind of funky looking. They have like big cushion soles, and she loves them. That's great. But when she wants to look fashionable, she puts on a pair of Nikes. So a lot of my friends wear those super comfortable sneaks, and I that's cool. That's cool. I get it. So Android PC. Yeah, I'll stay away from the Switch, buddy. Let's keep it green. Let's keep it green. All right, let's keep rolling here. We went over DocuSign. We went over Dropbox. Somebody asked for MKSI, and then I got to look at CBX. So let me look at CBX really quick, and then we're going to look at MKSI. So Chevron, the energy markets have just been, I don't know what to think anymore. Look at this chart. This is a big cap company. These guys make money. They make profit. I don't know if they're growing this year. I think they're contracting a bit because of oil prices, but you could see that this stock has been down, up. Once we're expecting that Trump was going to win, oh man, he's going to be so friendly to oil companies, and the stock really rallied, and now it's really dropped over the last month. It's down 11%. Now, My intent is to lower my position in Chevron. I'll own Chevron for a long time. It's good to be an energy investor. I just find myself that I've got too much in one stock within energy, and look what it's done over the last coming up on 3 years. Nothing. It provides a dividend, a pretty decent one. And if you're an income investor, maybe Chevron's a pretty good idea, because I mean, you held the value of your stock and you earned 4.6%. And if you had bought at the right times, like I bought some shares back here, and those shares are, have very good gains. But after that, it hasn't done much. And I'm looking at it going, well, is the oil industry going to be one of these really expansive, sectors? And the answer is no. I think it's going to be profitable at times, especially when you have oil prices above $100 a barrel. Man, these guys make money. But for now, I just wanted to trim back my position. I only have good things to say about Chevron. PE is 15, forward PE 14. The company is seeing a loss of revenue, but it's mainly due to the commodity price is down for oil. It's not that they're not, they're screwing up. Their volumes are right there. Their profitability. So their profits, you could see 40% margins. That's very good. This is a very old industry, right? More than 100-year-old industry. And they're still maintaining 40% margins, which is good. Oil is going to be around for a long time, probably for my whole lifetime. And I plan that these guys are just going to be in demand. I know that more EVs are being sold, but you'd have to sell 100 times the number of EVs we're selling today for a long time in order to really replace all internal combustion engines. So the margins are good. Cash flow is great. And you never know, as soon as you have some type of oil shock where the price per barrel goes up, this will be a stock that really works. So I'm holding my shares in Chevron until January. I have 92,000 in Chevron, and I'm going to probably sell $20,000 of it and hold that for a long time. So that's my plan on Chevron. And NCATer, you could tell me what you think over Discord. Now let's talk about MKSI. So this is an instruments company. Okay, cool. And Shadow Guy. So you're thinking it's fairly priced. Let's take a look. So these guys provide foundational technology solutions to semiconductor manufacturing, electronics, packaging, and specialty industrial applications in the United States, Germany, China, South Korea, and internationally. So they do instruments. Okay. Wow, PE is really high, but next year it's going to be nice and low at around 14. It's a buy according to analysts with a nice discount. It's had a contraction in revenues. The contraction is as recent as September. Okay. So we have contracting revenues, which is a little bit of a concern. And then we kind of margins these guys operating with. Pretty good margins, 47% margins. Free cash flow is there. They're not growing, so that kind of makes me a little concerned. Yeah, I think you could say they're fairly priced if you believe in the company, but I would actually think that it may be a little overpriced. If they cannot grow, they're worth $5 billion at best. If they can just grow a little bit, they're worth $7 billion, $8 billion, based on that free cash flow number that I looked at. Over the past year, it's really 6%, up 6% with the dividend. I guess you're up 7%. And over the 5-year, it hasn't really done much. So this is a company that, let me look at one more thing. So man, they were growing really nice here. So they had a nice run up on their stock coming out of COVID, and then they really came back down. So yeah, I probably I would not invest in this company because I probably wouldn't be able to establish a really good sense of, hey, are these guys really going to do well going forward, or are they just going to be a company that just exists without it really appreciating much? So this one doesn't float my boat. I wouldn't touch it. I wouldn't buy it. I don't think it's worth following and analyzing because it just hasn't done a whole lot. So that's MKSI. Thanks for asking. AMD. So AMD, $195 billion market cap. It's down for the 1 year, but it really had done really well with that whole AI hype cycle. But is this a good buy now that it's really sold off? And hasn't sold off a ton, right? Just a little bit. And actually, that doesn't really show me the story there. So if I look at the 1 year and I look at the peak to where it's at now, it's down 42%. So that's a pretty good drop. Now revenue is 24 billion, net income. My complaint on AMD over the years has been they don't produce a lot of free cash. So let's take a look at their margins and their free cash. Next year, the PE is going to be at 26. Now, when we look at their growth, they are growing, which looks really good. Yeah, it looks great. So they're growing nicely. Gross margins of 52%. So if you look at like NVIDIA or Broadcom, I don't know about Broadcom, but semiconductor companies tend to have good margins. This is a very good margin. But this cash flow, why don't they produce more free cash flow? So when we look at their free cash flow margin, 6%, which isn't terrible, but why can't you be higher? Is my complaint about AMD. So they're growing, good. They're in the data center, good. PC sales are picking up, good. So those are good things. This might be an interesting stock to invest in potentially. It isn't overvalued. So let's get into a valuation for AMD. And let me check something really quick. And it looks like I'm going to need to punt. I was expecting to go 1 hour, and unfortunately, I'm going to have to get going. But everybody, thanks for tuning in. Looks like we covered AMD. It is interesting. I'm going to look at it further, and I'll share my analysis on a video, and then we'll go from there. Looks like the market is going up. Looks good. Let's hope it keeps going up. Everybody, thanks for tuning in. XDiv, thanks for tuning in. Mike, Shadow Guy, appreciate it. Everybody have a good day. Thank you.